The purpose of this short video is to cover bond basics. And the reason why I'm covering bond basics is I want this video to precede hedging bonds. So hedging bonds with bond futures contracts. And so the reason why I cover this is I often jump right into, in a derivatives course or a financial engineering course, and start talking about hedging bonds and the risks of bonds. And it turns out that a lot of people don't recall the risks associated with bonds. For some reason, it was missed in the prerequisite courses for this course. So it would be their basic financial management course somehow overlooked bond risk. So this video will patch up those holes that you may have in your background, and for some of you it may just be a nice refresher. So let's look at a basic bond. Let's look at a bond now. A bond will have a coupon rate, and the coupon rate will be on an annual basis. So let's say we're looking at a bond with a 6% coupon rate. I'll explain what that means in dollars in a second. Most bonds have a face value of $1,000, and that's the size, unit size of a bond, is $1,000 face value. We're going to look at a bond that has 2 years to it. And I'm doing 2 years because I'm going to do some timelines in a second, and given the fact that most bonds pay semi-annually, which means there's 4 payments here, 4 payments. When you do a timeline and you start getting more than 4 periods, it just gets cumbersome because there's a lot of calculations. So I stick to 2 years with 4 semi-annual periods, and you'll get the gist of the calculations. And mentally you can see that, well, you know, if you have a 30-year bond with 60 semi-annual periods, it works pretty much the same thing. It's just the math is very repetitive. And then our goal here will be, one more thing, we'll have a yield to maturity. And let's say the yield to maturity of the bond is 6%. What a yield to maturity means is this is the interest rate that the market demands today given the risk of the bond. Okay? Now, if the market wants 6% from the bond and the bond actually generates 6%, the bond will trade at face value at $1,000. There won't be a premium. There won't be a discount. If the market wanted 5% from a bond that generates 6%, that would be an attractive bond because the market only wants 5. It generates 6, so that bond will trade at a premium because it's attractive. If this yield to maturity, given market conditions, was 8%. and the bond only generated 6, this would be an unattractive bond. It would sell at a discount, meaning it's selling less than $1,000. Now the goal here is to figure out the price of the bond. So given this information, how do you determine the price of a bond? Well, the first thing you do when you have these short bonds, meaning short time periods, is you can map it out on a timeline. And so what I'm going to do is I'm going to look at here is 2 years, and then here's the first 6-month period, here's the second 6-month period, third, and here's the fourth here. And I just say, look, this is 1 year, and this is 2 years, and then here's all 4 quarterly or semi-annual payments. And so the first thing you need to recognize is, look, this is a coupon rate that's an annual rate. So what this says is this bond generates $1,000 times 0.06, $60 per year in dividend in interest coupons. Okay, $60 per year. But the bond pays semi-annually, so it's going to pay $30 and $30, and that's the first year so far. In the first year, it pays $30. And then it's going to pay $30 again, and when the bond matures, it's going to pay the last coupon plus its face value of $1,000. Okay? So the way to look at the cash flow is, sometimes this maybe this will help you. It'll help you later on. Is that you often put these up arrows, meaning this is the cash flow you get back, positive positive cash flows is indicated with an up arrow. And when you buy the bond, this bond, we'll see in a minute, is worth $1,000. Okay? And so how do I know it's worth $1,000? And this is how much I have to pay for it. So I have to spend $1,000 in cash. It's why there's a negative sign. As well, what we do is take the present value of all these cash flows and discount them back at the yield to maturity, what the market demands, and that will determine the price. So you take this $30 and you discount it by the interest that this interest rate is on an annual basis. So what it says is it's 3% each period that we have to discount this by. Okay, so we're going to take 3% and discount it by one semi-annual period, and we're going to take this $30 and we're going to discount that by 3% for 2 periods, and this $30 and discount that 3% for 3 periods, and we're going to take this $1,030, you can just add these two up, and discount it at 3% for 4 periods. Add each one of these numbers up, and we'll get, this is worth $29.13, this is worth $28.28, this is worth $27.45, and combined, well, let me tell you what when you discount the $30 is worth 26, I'm running out of space here, 65, that's 26.65, and the $1,000 is worth today $888.49. Okay, that plus these two numbers will sum up to $1,000. Now remember with the $29.13, how to interpret that is you're going to get $30 6 months from now, right? Discounted back at 3% for one semi-annual period, it's worth $29.19. So if you were to invest $29.19 today, right here at time zero, invested at 3% for 6 month period, you would have $30 as a future value. So this is a present value. So, you know, the value of a bond is the present value of its future cash flows. Now, in finance, we need to account for risk, and where is risk accounted for? It's accounted right in here in the yield to maturity. The yield to maturity reflects the risk of the bond, and that can change. This yield to maturity can change. This coupon rate can't change for normal fixed income securities. The face value can't change. Well, over time, the number of years will change because as it matures, things change. But the yield to maturity can change at any point given the whims of the market and where general interest rates are going. And so what you need to do is you need to look at that yield to maturity and say, you know, is that a fair yield to maturity given the risk of the bond? And that's how market prices are set. So the price of this bond, this fixed income security, is $1,000. Why is it a fixed income security? Because these coupon payments are fixed in dollar amount, and they're fixed when the payments are made. The payments are made typically semi-annually. And we usually start out, and think of it, to make it simple, we start out at time zero, and then the next cash flow is 6 months from now, and the next cash flow is 6 months from now, and so on. So that's the very, very basics of bonds. Now look what would happen if you were to change the yield to maturity to 7%. And say, look, interest rates went up. It could be because bonds became riskier in the market. The economy became overall riskier. What would happen to the value of this bond? Well, you just put in 3.5%, substitute the 0.03 out, put 0.035 in each one of these terms. The denominator goes up, which means the price is going to go down. If you do the calculation, you'll come up with, for a yield to maturity, yield to maturity 7%, you will get a price of $981.63. Okay, now let's interpret that. The bond only generates 6%. The market is demanding 7%, so this bond is not as attractive as it used to be. It's selling at a discount relative to its face value. Face value is often called its par value. Now, what if the yield to maturity was 5% instead? Now, 5% means, look, that's what the market wants from this bond, 5%. The bond generates 6. So this bond, if you were to substitute 0.025 in each one of these areas, you would get a price of $1,118.93. And what that says is, look, this bond is trading at a premium because it generates 6% rather than the 5% that the market is looking for. It's an attractive bond. And so notice this $981. This bond lost 1.837%. So if the bond was initially priced at 6% and interest rates went up in the market to 7%, this bond would fall 1.87% to 981. If we started out at 6% and interest rates fell, the bond would go up to $1,118, and that would be a gain of 1.893%. So either way, this bond goes up or down about 1.83% for a 100 basis point change in interest rates. In other words, every 1% change here from 6 to 7, that's 100 basis point change. Or 6 to 5, that's another 100 basis point change. Then for a 100 basis point change, you get this percentage change. And that's not very much. I mean, look at it. Interest rates change by 100 basis points up or down, and you lose less than 2%. That's basically a capital gain and loss of about 2%. Not very much. And so how do you know? And so why is that? Well, because it's a very short-term bond. Very short-term bonds are not subject to a lot of risk, because if you look at the math in the graph, the cash flow doesn't go out 30 years, for example. And if it goes out 30 years, you're taking these numbers here in the bottom. You're taking, say, 1.03 and taking it to the 30th power. Do you know what happens when you change interest rates a little bit? What happens to this present value term? It changes by a whole lot. So the point is, this is low risk when you look at it. And the reason it's low risk is because this bond has a very short maturity. So that's why we look at money market securities, for example, which are very short term, as being very low interest rate risk. So let's be clear of the risk that we're looking at here. We're looking at a bond, and the primary risk associated with a bond is interest rate risk. And where does that interest rate risk come from? Well, the cash flow of the bond is all fixed. What changes is market interest rates. The economy constantly changes every day, and so in this video, since I started it, interest rates have changed. And bond prices have changed to reflect that. So now, the next thing we want to look at here is look at the relationship between bond prices and yield to maturity. So you should have seen this graph before, and the graph would look something like this. Okay? And so when we had a yield to maturity of 6%, we came up when we had a price of a bond trading flat. In other words, flat means no premium, no discount, at $1,000. When we looked at 7% yield to maturity, we had a price of $981 and change. And when we looked at a 5% yield to maturity, we had a price of $1,118.93. Okay? So you can see the inverse relationship between interest rates and bond prices. And that's what we're seeing here. Yield to maturity being an interest rate, the market interest rate. So now what we want to do is we want to know how steep this curve is. And the reason we want to know how steep that curve is because this curve, the steepness of this curve, tells us how much risk the stock is the bond is facing. Because if this curve is really steep, really steep like this, that means an itty-bitty change in interest rates causes a really big change in bond prices. Get it? And if it's really flat, that means interest rates, they change a little bit, bond price barely changes. In this example that I just gave you, 100 basis points is a pretty big change. I've drawn it a little too steep for what it ought to be. It should be drawn a bit flatter. I mean, notice how I drew this. This can't be zero right here because this can't be $981 covering my fingernail here, and this being drawn in proportion. But the point is, this would be relatively flat if I drew this correctly in this to scale, so to speak. Okay? Now, this is flat because it's a short-term bond. If I had a long-term bond, then it's likely to be really steep in terms of the slope, the negative slope. And so that's what you need. One thing you need to get to wrap your head around is long-term bonds are riskier than short-term bonds. That's one of the main drivers to risk of bonds, all else being equal. Now, there's a way to try to capture this risk in a measure called duration and its cousin, modified duration. And so what duration tries to do is, let me show you graphically as best I can here. What duration tries to do is it looks at the cash flow to the bond. And in this case, we're looking at 1, 2, 3, 4 semi-annual periods. And if we map the cash flow here, we get something, again, I'm not good at drawing things to scale, but we're looking at cash flow on this axis, and we're looking at time on this axis. So the first 6 months, you get the $30 cash flow, $30 cash flow, $30 cash flow, and then the last cash flow coupon is $30, plus you get the $1,000 face value back. So almost all of the cash flow is in the last quarter. Okay? Now, what modified duration does is it tries to measure this interest rate risk. And it actually does. It's a statistic that measures the interest rate risk associated with a bond. And that's the risk that people who use bond futures contracts try to offset, manage, and target. And that's why I'm putting this video together and talking about modified duration and duration, because once you get a handle on modified duration, you understand the interest rate risk that's embedded in the bond, and then you can take a bond futures contract, figure out its duration, and use the two to offset each other. Okay? That's what we'll be doing in later videos, but this primer is just primarily about bonds themselves. And so here's the cash flow, and here's the time associated with those cash flows. And notice what happens. You notice you take a small cash flow, and we have a small cash flow for a short period of time, a small cash flow for a short period of time, a small cash flow, and we're getting further up in time. And then we have this big cash flow at the very end. What modified duration tries to do, conceptually and visually, is think of this as a seesaw. This is a seesaw with four little kids. Think of it as 4 little kids here. And then sitting on the lap of this kid right here is sitting on the lap of an adult. And if you tried to balance this seesaw, where would the fulcrum be to get this to balance out? Well, what are you exactly balancing? Well, you're balancing, in a sense, this time. You're balancing time versus the size of the cash flows. And if most of your cash flows are at the very end, then that means you're going to have a lot of weight distributed here that makes the bond really risky. If this cash flow somehow got moved over here, it would be much less risky. This fulcrum measures the amount of risk that's associated with the bond in terms of what's called Macaulay Duration. Okay, Macaulay Duration. And Macaulay Duration goes from 0 to the maturity of the bond, and the maturity of the bond is often M for maturity of the bond. So this fulcrum, in other words, has to be somewhere between 0 and M, somewhere in between here. To get the balance, this 4-year bond, or 2-year bond, 4 semi-annual periods, it's got to be about here. which means, ballpark guess is the modified duration measured in semi-annual periods is over 3. And if you divide it by 2 to get it back on an annual basis, you're probably, we could be somewhere around the 2-ish area overall. And so this relationship between duration, modified duration, and the percentage change in bond prices can be put together in a formula that's pretty simple. Okay? This says the percentage change in a bond, right? And so I showed you a percentage change in a bond right here, right? I showed you it was up or down about 1.8% in that bond earlier. So the percentage change in the bond is equal to, and there's a minus sign right here. It's very easy to forget the minus sign, and I'll explain that in a second. It's equal to the Macaulay duration, this fulcrum to try to balance these cash flows against time. Okay? Divided by 1 plus the yield to maturity. Okay? And the yield to maturity of the example I just showed you, the yield to maturity here was 6%. Times the change in basis points. So if interest rates, as I was showing you here, changed up 100 basis points, down 100 basis points, right? That's the change in basis points. Divided by 100. Okay? So if you're looking at 100 basis point changes, then this right here is a change of 100 divided by 100. That's 1, and it just boils down to this math. Now what's the negative sign doing here? Well, if basis points go up 100, if interest rates go up 100 basis points, this is positive. But bond prices fall, right? And so that's what the negative sign here is doing. It's captures that inverse relationship, this negative slope that you need. Okay? So what you further need to know is, see this guy right here? I referred to it as duration's cousin, modified duration. This term is called MD, modified duration. And it's nothing but the duration here that you see with the fulcrum. Okay? And if you took investment management, either MBA 627 or Finance 327, when I teach it, we cover how to actually calculate duration. But that takes us too far astray for a financial engineering course. But it's appropriate for managing bond portfolios. But we're trying to focus on hedging with risk. Just want to give you a flavor of what modified duration is all about and how it applies to the riskiness of a bond. So now we got duration, Macaulay duration, which is this fulcrum. We divide it and we make this adjustment, 1 plus the yield to maturity in decimal form, and I'll explain that in a second, for a given change, basis point change in interest rates. And when these basis points change, and you're looking at a bond with a certain duration and a yield to maturity, then you're going to have a certain change, plus or minus, in the bond price. Well, that's bond price risk. Okay? So, why is this adjusted for 1 plus yield to maturity? Well, the short answer is that's how the math works out. And if you took the MBA 627, I would show you how to derive this formula. I mean, you won't be too happy to see it. And I wouldn't ask anybody to derive the formula. Just work with the bottom line conclusion to the formula, so to speak. But then again, that's not where we're going. But look, you can see why this yield to maturity pops, why we're dividing by yield to maturity. And you see how this slope, see how the slope here gets flat? So when the yield to maturity goes up, and you divide by 1 plus the yield to maturity, 1 plus, say, 0.06 in the example that I was looking at, then it accounts for the flatness that's going here, helps account for some of the flatness. And when you're over here and it's really steep, then the yield to maturity is very low. You're over here, yield to maturity is kind of low, and so when you divide by a small number, it changes this increase in percentage change. Now the yield, this modified duration is technically an approximation, so it should have a squiggly equal sign there. And what I mean by that is this is a linear approximation to the actual change. The actual change is curved, you see that? But this modified duration is an estimate, assuming a linear relationship between bond prices and yield to maturity. And so if you have very small changes in basis points, like interest rates go from 6% to 6.03%, then that's a very small change of 3 basis points. Well, you go up just a little bit, and you have a very good approximation using this modified duration concept. Okay? If interest rates jump a whole lot, 100 basis points is pretty big. You're going to have some sloppiness here, and that's what the difference between the curvature, the convex line, and the estimate using modified duration. That's a measurement. That's an error measurement because this is just a linear approximation. You're also going to get it when you go down a lot with interest rates. You'll get that error. So this technically works when interest rates change a little bit, and this is where interest rates are changing. It works, but 100 basis points will do it, for convenience purposes, but it's kind of a big jump. But the point is, if you go anywhere near bonds and bond portfolios, you can't begin to understand them. You can't read the literature. You can't go anywhere working with bonds without understanding duration and modified duration. It's the key to understanding bonds and bond risk. And what risk again? It's the risk that risk meaning changes in bond prices due to change in general interest rates in the economy. And in the context, changes in yield to maturity of the bond that we're looking at. Okay? So the point is, the higher the modified duration, the more risk you have in the change of the bond price. Okay? So when interest rates go up a whole lot, this negative sign tells you the bond price is going to go down a whole lot. And again, which bonds are the riskiest for modified duration? The ones that have really long maturities. Because if you have a really long maturity and you have to move this fulcrum, where's the fulcrum going to do balance all these cash flows? Way out here in time. And if that's the case, this D is really high. And if the D is really high, the bond is very sensitive to changes in interest rates. You're going to get a big capital gain or loss. So now what I'd like to do is actually go and look at the calculations that you're not required to know and actually do, and look to see how the calculations of Macaulay Duration tie into the formula that we've been looking at, this particular formula. So let's apply it to this bond. We kind of know the answer before we go any further. We know the answer to the problem because I showed you earlier that, look, if you with this 6% bond that we've been dealing with, if we raise interest rates 100 basis points, the price will drop about 1.837%. If we drop interest rates by about 100 basis points, we have a gain of 1.893%. So what should happen is, as a guideline, we're going to change basis points by 100 here. So 100 over 100 is 1, so it kind of drops out mathematically. You don't have to do any calculations. Then I'm going to calculate this D right here. And I'm going to take that D, put a minus sign in front of it, divide by the yield to maturity, which is 6%, which is where the starting base we're starting from here with this bond. And I'm going to show you that it approximately equals, see the squiggly equal sign, the percentage change in the bond price. So here's the calculation. What we're doing here is just taking the present value of each of those cash flows that the bond throws off, as I had showed you earlier in this slide. Okay, I'm going to show you the present value, each of the cash flows. That adds up to $1,000, and that's a check to make sure you captured all the cash flows. So this is all the cash flows associated with the bond. Then what is the percentage of those cash flows relative to the price? So this $29 is just under 3% of the whole total cash flows of the bond. In other words, the value of the bond. And then we have 2.8, 2.8. I got a little rounding here. And then, almost 92% of the bond is tied up in the last cash flow, period 4. If we take those percentages, multiply them by t, the time, and then add them up, we get the duration. But this duration is in semi-annual periods. Just divide it by 2 to get it in years, because the formula that we're looking at here needs duration in years, D in years. And so what do I do here down below? So I get a duration of 1.9 years. Plug that into the formula. Assume 100 basis point change in rates. So that math kind of drops out right under my fingers. And I get a change, in this case a negative 1.806, which is pretty close to the drop in interest rates that we calculated for real. I mean, when I say for real, this is the actual change in the rate that we would lose about 1.837%. And then remember, this is an approximation, and we're pretty darn close. So that's just a little background that this modified duration doesn't come, and duration doesn't come out of thin air. It's not hard to calculate, but it's not this course. Investment management is where we calculate this duration. Now what I want to do is again show you that, and I'm going to spin out of this webcam video and move into recording the screen, because I'm going to take you to a Vanguard website. Vanguard is a mutual fund complex in Pennsylvania that's very well known. They manage hundreds of mutual funds, and they have a lot of stock funds and a lot of bond funds and a lot of just mixed variety of funds. So what I want to do is focus in on the bond funds and show you how they use duration and why they're advertising, so to speak, the duration of their bond funds. And why would people want to know the duration of a bond fund? Okay, so here we are in Vanguard's website, where it discusses their various mutual funds that they offer investors. Investors like you or I, who can invest in these bond funds. And so it gives you a little, some background on duration, okay, bond fund basics. And then it talks about duration, as you can see right here. Duration is a useful measure. A useful measure is useful in measuring a bond fund's sensitivity to changes in interest rates. The longer the duration, the more the bond price will fluctuate when interest rates change. And it shows you kind of a neat little mechanism here that shows you, look, if you start out with an initial value, a bond fund now, these are hypothetical bond funds, short-term hypothetical bond fund, an intermediate, maybe 5 years or so is the average maturity, and a long-term hypothetical bond fund. Now, the duration of a bond fund, and a bond fund could have 1,000 or more bonds in it, it's just a weighted average of the durations of the individual bonds in the bond fund. Simple weighted average. So add up all the durations of each individual bond, add them all up, and divide by the number of bonds in the portfolio, essentially, and that's what you have. Okay, so now it's saying, look, let's start off and look at this little slider here. We've got a slider here. Don't confuse this with the fulcrum idea that I had mentioned earlier. This is not the fulcrum thing. So here we have a change in interest rates on this sliding scale. If we start off at 0, all funds start off with a $1,000 initial value. Now if we raise interest rates 100 basis points, look what happens. Short-term funds only drop by about $25. Intermediate funds drop by $60 or 6%. And then long-term funds are dropping by 12%. Which indicates, you have duration of around 12 in this case. Okay, now if you increase interest rates 2%, get that over here. You can see a much larger drop and twice as big of a drop. And then if rates fell, which is good for bonds, holding bonds, you'd have gains of 25, 60, and 120, and so on. Okay, so that's not unusual to see various mutual fund companies show you, give you some background on bond basics, because it's extremely important for as an investor to know how sensitive your bond portfolio is to changes in interest rates. So if you go to Vanguard's, another page on Vanguard's website, you can look at U.S. bond funds, and you can see the asset class, the type of securities they're investing in, the number of bonds that are in these funds, the duration of each fund, and the average maturity, the yield to maturity, and the average coupon. Now, one of the tricky things about this is, they say duration. So which is it, Macaulay duration or modified duration? Turns out that this is modified duration. So it's easy to calculate a 100% basis, the effect of a 100 basis point change in interest rates. Basically, if you look at this, let's find a fund that you might be familiar with. So let's look at this intermediate Treasury bond fund. It has a duration of 5.2 years. So if interest rates go up 100 basis points, this bond fund is going to go down about 5.2%. Okay? Notice that the duration is slightly less than the maturity. And that's true for short-term and intermediate bond funds. The duration here is going to be slightly less than the maturity because of that fulcrum idea. The fulcrum has to be a weighted average of those cash flows times T. Now, look further down here. So those are intermediate. Now let's look at a long-term Treasury. Now, a long-term Treasury, look at this, 17-year duration. And the average maturity is 25 years. As you start getting up in long-term maturities, the duration kind of starts to settle in towards, below, in some cases significantly below the maturity. And that has to do with the math. So we got a difference here of about 8 years. But again, look at average maturities in years, and duration, by the way, is in years. And so look at this bond fund, at this long-term Treasury. If you go into long-term Treasury fund, if interest rates go up 100 basis points, you're going to have a 17% capital loss. Ooh, that's that's almost like a bear market, and the stock market drops 20%. Some people define that as a bear market. So if interest rates go up 100 basis points, you're in long-term Treasury, you're in a bear market with bonds, at least long-term bonds. And so here it is for all their bonds, and they're not showing you this for fun. People want to know how sensitive their investments are to changes in interest rates. And if they predict, now here's strategy. If you predict interest rates are going to go up in the future, you want to get the heck out of these long-term bonds and put your money, transfer your money into, let's find it down here, short-term. Go to short-term Treasuries, because short-term Treasuries, you're going to have a very small capital loss here, 2.2 years if you go into this fund. So you strategize. If you can predict interest rates, and if you think interest rates are going to go up during that time period, you switch into short-term bond funds. Get the really low duration. And if you think rates are going to fall, before they fall, you go into long-term Treasuries or long-term bonds with high durations, and you're going to get that big capital gain. So now, with this background, let's go. We'll go into the next video looking at bond hedging and target hedging using bonds and bond futures contracts.